Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Paris milling wheat. There had been here one continuing dominant pattern, a quite large pattern that 11 weeks ago took a break on the downside. It is of course the dark blue highlighted late August 24 to late February 25 ascending triangle pattern. This pattern had the requisite number of combined 5+ touches and is made up from a lot of smaller patterns within it, but it can be clearly seen on my daily chart. 12 weeks ago I laid out targets below for this pattern, and I quote, the primary target X would be in the 226 zone, the secondary hard to reach target X1 down in the 194 zone, end of quote. 11 weeks ago the market reached the primary target X, pushing down below it. However, we had a stall in the movement lower during the first part of March, prompted by the market trying to test down towards the 50% absolute Fibonacci line at 219. This action will become very crucial to what happened next, beyond the obvious significance as a 50% absolute Fibonacci line. You see, it had importance because it helped hold up prices back in November and early December last year, and also eroded the bearish incentive back in August and September as well last year. The reactionary rise only managed to move up to the declining long moving average, currently at 226. Not even testing it, but rejecting further upside pressure, and we dropped lower after that, more or less down to the lows that were not seen here since March last year. Anyway, 11 weeks ago I amended the still open further targets below into target X1 being at 205 as a secondary harder to reach target, and target X2 being a tertiary target and even harder to reach target down at 194. I asked the question back then, and I quote, the question still remains as to whether prices will take this time to form a possible bearish halfway hesitation, or will they recover further? The latter seems unlikely right now, and the former, well, it is too early to say, though it might comply with what's going on in the other grain markets, end of quote. I added 5 weeks ago, and I quote, comply? Well, the market did, as we've dropped down through the 50% absolute Fibonacci line and has shown a new close-in target X4 for the bearish halfway hesitation down in the 206 zone, which I have since finessed to the 208 zone. This is the most immediate opportunity on the downside, end of quote. 3 weeks ago prices reached target X4 at 208, and 2 weeks ago they reached target X1 down at 205. This just left the tertiary and a much harder to reach target X3 down at 194. I said earlier that the action over March was going to be very significant. Well, you can see by the bright green March-based bearish shift push pitchfork that it was, as this pitchfork became excellent at showing the bearish angle of attack of the market from March until last week when we had changeover. Prices are now just over the bright green upper time, currently at 209, and just under the 50% absolute Fibonacci line at 219. This new development seen this week happening with changeover gives a whole new series of market dimensions to contemplate and see what may be affecting the market. It will take some time to study, but I suspect the tertiary, so hard to reach target X2 below, may now be out of reach. Minneapolis wheat. We have one key pattern to look at here and a number of newer patterns and levels to discuss as well. The key pattern is the previously highlighted sideways triangle created by the stalwart overhead, and it is really stalwart, dark blue July 23 2-day downtrend, which remains unaltered, currently at 613, and the bright green early March to mid-May uptrend, currently at 613 also. After some hesitation over the last few weeks, prices finally pushed lower this week down to the slightly realigned September 2019 today uptrend, currently at 573, before a changeover gapping move higher. There is no bearish halfway hesitation to consider here, as we have seen elsewhere, nor is there a 38.2% Fibonacci line, as that is down at the 537 level. So it was, still is I suppose, a straightforward attempt lower, though we also had support at 578 and in the congestion scene between November 24 to January 25 between about 585 to 611. There are a couple of other features I'd like to expand upon that may help in deciphering what is going on here. 2 weeks ago I drew a bright red mid-March to mid-April bearish shift pitchfork. I said at the time, and I quote, "This seems good right now, despite its young age, as showing the bearish angle of attack," end of quote. And good it has been, as prices have stayed just about in between the bright red lower time below, currently at 572, and the bright red middle time above, currently at 596 at the moment. This is a much more shallower pitchfork here than elsewhere. All this action has nevertheless still left us with some targets below for the first pattern, the original sideways triangle, of a primary target X in the 562 zone, not too far away, and a secondary, harder to reach target X1 down in the 520 zone. I said 2 weeks ago about these two targets, and I quote, I am not sure about these two, but for now they will do, end of quote. Well, for now they will still do, and I'd watch the bright red bearish shift pitchfork for the immediate future of this market. London UK feed wheat. There continues to be here on this daily chart, even now, these many months, close to 1 year even, only one major significant pattern here, and that is the bright red late May to early July 2024 bearish shift pitchfork. The market in late February this year reasserted the dominance of this pattern, with prices breaching, then repairing an attempted break higher over the bright red upper time, currently at 174.5, back in late January and early February. Add to this the earlier this year narrow mix overhead of all the moving averages, though they are now separating out, as well as the 50% absolute Fibonacci line at 180.5. And you had, and I suppose still have, a compacted area overhead that, as I've repeatedly said for months and months, that had been brewing up for a significant move, which happened, or should I say started to happen, over late February and into March. It was, as I said, 23 weeks ago and ever since, and I quote, "Even now still looking for that better pattern to appear. Until that shows up, I'll continue utilizing the bright red bearish pitchfork," end of quote. So my point has been, and still is, that the bright red bearish pitchfork was and is, after all the temptations of other patterns, still the key pattern I was looking for here all the time. This leads me to my final 4 points, and 3 of them were something that I noted in my recent annual commentary on London feed wheat at the beginning of the year. Firstly, I saw there the potential for a very large May 23 to date cat's ears pattern. This is a bearish pattern akin to a double top, formed after a big fall such as the fall we had earlier in 2023, as well as an even longer term second pattern, an August 2020 to date very large head and shoulders top pattern. These two super long term patterns are still live, and they are both relying on one feature. That is their common neckline on my daily chart, currently at 167.70. For most of March, prices slid along the top of this support of these pair of necklines. However, recently we've dipped, recovered, and then again 3 weeks ago dipped again below the neckline, setting up the opportunity for a recent bearish halfway hesitation for potential target X down in the 151 even zone, at the same time making the lowest lows and low closes since March last year. The third feature is a little more longer term. It is the March 2016 to date, recently finessed this week again uptrend, currently at 155.05. For the last few weeks we had the market pressing on the dark blue necklines as well as this uptrend. I said 2 weeks ago, and I quote, "It looks right now as if we are finally breaking below it now." as well as pushing down through the congestion between March and April 2019 between 161.95 to 165 3/4. Well, we finally did push below, as well as below for the first proper time since July last year, below the bright red middle time, currently at 156.70. We now have below the February 24 low at 154 even and the March 24 low at 153.65, quite close together. It'll be interesting to see how the market treats these two. Now, going back a little, I have said here repeatedly there was one major, possibly severe criticism of the two necklines, and that is they have been previously breached, and some would argue broken. However, I counter that by saying that I transpose these from my longer term monthly charts, and whilst on a daily and even on a weekly chart they may be appearing breached and broken on the longer term monthly charts where they really live, they did not look, well, they did still look somewhat valid. And as I also said repeatedly, and I quote, I would not take these as cast iron lines in the sand. It should not be crossed, but as longer term strategic positions that we should bear in mind and occasionally bring a closer eye upon, such as now. End of quote. I added 2 weeks ago to this, and I quote, this week is the first week in quite a while when I really think we have broken the back of this support. We have not only had a significant monthly close below these key necklines, but we also did it with a monthly key reversal down. Now, 1 month does not make a major change in my monthly chart, but it does set up the situation to see if May and even June will follow through lower. Watch this space. End of quote. Today, I still stand by those words. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.